Namaste. Welcome to our channel Rathish Chartered Accountant. Today we are discussing about acceptance of deposit by a company or NBFC or a proprietorship firm or a firm on a non-repatriable basis. That is, if a company or a proprietorship firm or a firm, normal firm, registered firm or a NBFC does needs the funds for its working capital purpose and it is not repatriable, that is, it not be returned back outside India, then the rules and regulations that is to be said, I am just saying about here. The deposit that is accepted from outside India should be in the form of a private arrangement or a public deposit scheme. So what is called a private arrangement? A private arrangement means normally if I and some other person, I and one of my client is just entering into a loan arrangement. That is, I just need some money. I'm just asking him. He is just giving me some money. So I'm just making in a document itself or a check itself. I'm just getting it from him or I'm just giving him a check. In that way, that is called a private arrangement. It's just not registered or something like that. And also it can be accepted through a public deposit scheme also. Public deposit scheme means that it can be a public auction should be done in a public document. That is like a newspaper or something like that. In that document, everything should be said about the company and it should be accepted through the normal bank channels. The acceptance of the deposit by a company or a firm or something, it is not repatriable. It is not repatriable. That is, it is not returnable outside India. So it can be only repatriable, returned in India itself only. The deposits can be accepted by a company, NBFC, that is a non-banking financial company. It can be accepted by a proprietary firm. That is, if I'm just starting, normally in my name, I'm starting a business, it is called a proprietary firm itself. And it can also be accepted by a partnership firm. What is called a partnership firm? If I and some of the 3 or 4 persons clubbing together to start a business and it is registered, it's just made under an instrument, that is a partnership deed, it is called a partnership firm. So the deposits can be accepted by company, NBFC, firm, proprietorship firm in such kind of way. If it is a company, it should be registered with the Indian Companies Act, that is the MCA, Ministry of Companies Affairs. If it is a NBFC, non-banking financial company, it should be registered with the RBI and it should have a credit rating as set by the RBI guidelines itself. If it is a proprietary firm, there is no kind of a registration absolutely in India. And if it is a firm, it can both be registered and non-registered. Registered firm means it can be registered with the registrar of firms in the concerned state. If it is also non-registered also, there is no issue. But if there is some dispute arising between the partners, there will be a legal issue. A rate of interest can be paid to this who are maybe giving the deposits. So what is the rate of interest that can be given? If it is an NBFC, it should not exceed the rate as prescribed by the RBI or the RBI guidelines. If it is a company, it should not exceed the company's acceptance of deposit rules. And if it is a case of a partnership firm or a proprietary firm, it can be as per the RBI rules. That is, it should not exceed the normal banking rate itself. The deposit should be for a maximum period. There is a maximum period that can be, the deposit can be kept by the company or NBFC or the other concerns itself. So what is the maximum period? The maximum period is 3 years. You could not keep a deposit for more than 3 years. If it is after 3 years, it should be returned back and you can repurchase or renew that deposit. Deposit should be accepted in rate that is not more than the prescribed by the RBI in the case of NBFC or the proprietary firms or the partnership firms. In case of a company, it should not exceed the deposit acceptance rules as prescribed by the MCA, that is Acceptance of Rules 2014. Deposit should be accepted from the abroad itself. That's that for that purpose only we are just complying with the rules and regulations. When we are depositing the deposit from the abroad itself, it should be accepted through an NRO account. As it is a non-repatriable basis, we are accepting the deposit non-repatriable. That is, we are not repaying back to the outside India. We will be repaying back it to the customer itself, but we will be not repaying itself from the outside India. So it should be accepted. The deposit amount we have received itself from all or something like that, you should not use for any real estate purpose also. And the company in which the deposit is received or the NBFC in which the deposit is received should not invest this in another company doing these kind of activities. That is agriculture, plantation, real estate or a re-lending purpose also. It should not be used for this. This is one of the most important criteria that is to be used, should be followed by the person who is accepting the deposit. The amount of the deposit that is received should be returned back after 3 years. It should be only returned back through an authorized dealer only. You should have to return back it through an authorized dealer. You should return back it through the NRO account only. You should not be returned back it to the NRI account or FCNRB account. As you are just accepting the deposit through an NRO account, you should return back to the NRO account if the customer is the non-resident person at that time itself. If he or she is a resident person, you can return back the account through the normal banking channels in India itself. It is not repatriable to outside India itself. It can only be returned back to India itself. It cannot be returned back to outside India after the 3 years. I can just summarize activities or the rules and regulations that should be followed by a company or an NBFC or a proprietary firm or a registered and non-registered firm accepting the deposit from outside India for their working capital or whatever the purpose is. Company or NBFC or other concerns can accept the deposit through a private arrangement or a public deposit scheme. You can pay the interest to that deposit. It should not exceed the rate as prescribed by the RBI or the company's acceptance of deposit rule. Deposit should be accepted through an NRO account. It should not be made through a transfer from the NRI or FCNRB account. The deposit should be repaid back after 3 years. Repayment of deposit should be through an authorized dealer and it should be through the NRO account itself. The deposit is not repatriable or it should not be gone outside India. It should be only returned back to India after 3 years itself. Deposit should not be used for the re-lending purpose, exemption for the NBFC, and it should not be used for agriculture, plantation, real estate purpose, or it should not be invested in any company doing these kind of activities. There is no maximum criteria which is said in this one. These are the normal rules that should be followed under FEMA Act when you are accepting the deposits from outside India for a firm, company, partnership firm, etc. And the firm should also comply with all the rules and regulations in a country, that is whether it is a central government or state government or MCA, PF, ESI or whatever the thing, it should comply with all the rules and regulations in that country. In that way, you can accept deposits which is non-repatriable from abroad for your working capital purpose or your needs. And you can expand your business in that manner itself. As all of you know that what is an NRI, NRO, FCNRB account? NRO is it's a non-resident account itself, but it's made in Indian rupees itself. But it's NRI and FCNRB account. The partnership firm or this, it can only be accepted through the NRO account itself, and it cannot be accepted through any NRO or FCNRB, and no amount can be transferred from the NRE or FCNRB account to this NRO account for this deposit. It is not repatriable outside India also. You can pay the interest. The interest should not exceed the amount as prescribed by the RBI or as per the company's acceptance rules. In case of a firm or a company, it should not exceed the normal FD interest rate. Thank you for watching my video, Rathish Chartered Accountant. Hope all of you enjoyed this video and put your comments in your comment box itself. This is Rathish signing off. Thank you.